Hello and welcome to a special webinar from Fat Profits. Thanks for your company today. My name's Roger Malik. I'm the Head of Client Services in our Sydney office. And joining me today in our Fat Profits studio is our Senior Account Manager, Edward Allen. Edward, welcome back to the webinar. It's been a while since we got together. How are you?
Yes, g'day Roger. I've had a bit of a break and I came back obviously last week. And yeah, it's been a very, very busy first week back. A lot of new members joining, obviously, looking to capitalize on a falling market. I mean, obviously, we don't believe we're at the bottom just quite yet, but we'll explain that shortly.
Absolutely, lots to talk about, but as the title suggests, are we in for a bust of the market? Are we headed back up? So there's a lot to talk about, and we'll explain Fat Profits views in a moment. But before we get into today's discussion, a bit of disclaimer: all our presentations from Fat Profits are general in nature. We're not here to provide any personal advice. If you're looking for that, please see your financial planner or advisor before acting on any information. And also, past performance is no indicator of future performance. And during today's session, we've got a Q&A at the end. So if you've got any questions, you can ask at the end of the presentation. And we'll also have our emails and phone numbers. If you've got any questions you want to forward to us, not a problem. And of course, during the presentation, if you've got anything you can ask. Now, what we'll be discussing today, firstly, obviously, where the markets are going. We've seen a bit of a drop in the markets, and we'll discuss, is there further downside to come, or are we expecting a rebound? We'll discuss a few undervalued stocks today for you to buy, so get a pen and paper handy and add them to your watch list. We'll also share our income and dividend portfolio, which is very popular with our paying members, and it's been producing fantastic returns over the years. We'll discuss lithium, nickel, and there's also a bit of an education piece on dollar cost averaging, something we certainly believe and practice, and we'll educate a few of you today. We'll also give you a bit of a sneak peek into our members website, so you can see what that looks like. We'll tell you who we are, what we do. There's also a special offer for you to join our service today, given it's coming up to end of financial year. A lot of people are interested. And also we'll talk about financials, agricultural stocks, and stocks to avoid. Towards the end, there's also a high conviction buy, so certainly stay tuned for that one. That's a fantastic stock. You'll love the look of that. So let's look at first thing first. Currently, we've got a tug of war between the bears and the bulls, and it's pretty obvious that the market's trying to work out where they're headed. And if you have a look at this old saying, sell in May and go away, what are your thoughts there?
Yeah, look, it is the old saying. It doesn't always work because we know, like, we've been here for 22 years. I've just come back from long service, so you've got to be in the market when the market turns. So we know what's going on at the moment. There's COVID issues in China, the US. The numbers coming out there are not great. It's causing a sell-off in the markets over there, in particular on the Nasdaq and the S&P 500 as well. And here on our shore, we've got an election where, you know, recently both leaders haven't convinced the Australian public that they're the party to move the country forward. But what we do know, they've got us to here, and they'll get us to where we need to get to in the future. But perhaps not the most popular leaders going into this election that we've had probably ever, I'd say. But you need to be in the market when the market turns. That's the key, and we're going to show you how to position your portfolios during this presentation, just in a quick snapshot. But we're helping our members at the moment. Some are a bit nervous, but the long-term members, you know, they know what to do. We've been here before, and we'll touch on that. But again, you need to be in the market when the market turns, or you absolutely miss out.
Absolutely. Thanks, Ed. And if you look at this slide, this will be quite interesting for you guys to look at. You may probably never looked at this before. This is a snapshot of the last 50 years of the S&P 500, the biggest market in the world. And you can see an average 6 months rolling return, and it clearly shows that the best 6 months are from November, and you can see in the green on the right-hand side, November to April, where the markets run about 10.5% during that period. The worst, which is in the red, it's again very clear, from May to October. That 6 months rolling average is only 2%. So some might argue that if you avoid that 6 months period, and you come back in the market in November, you give yourself a pretty good chance of making better money. So yes, on one side, you may look at that, but there's another side to this argument. And if you look at this following chart, this is again a very long-term chart of the S&P 500. And the blue line shows you that if you simply buy and hold throughout the whole time, if you'd invested, into the S&P 500, your money would be worth $4.5 million at the same time. But if you bought and sold in May and bought back in November, and you did that every year for a long time, you'd actually end up making $1.2 million from the same investment. So it clearly shows that buy and hold quality companies long term really produces the right results, and you've got to try and avoid timing the market. Time in the market is the key, not trying to time the market. Now, if we look at the S&P 500, Ed, over to you. Tell us a bit about the US market, please.
Sure. There's obviously the numbers coming out, the payroll numbers, and the inflation numbers, and the employment numbers as well, has put a lot of pressure on this particular index, which is the key index in the US market, the S&P 500. Look, there is a double bottom in the short term, and there was also a double bottom in March as well. You can probably call it a triple bottom briefly, and the market's recovered, but couldn't hold that 45.80 line there. You can see in the black line on the chart, and then it's gone down again. More numbers have come out, COVID concerns in China, and obviously we've got a war that is escalating there in Ukraine. So, and then that growth period now is consolidating with the US. We said that last year. We predicted a 15% correction. It's gone a bit further than that at the moment. But you can clearly see there's a bottom resistance there of 41.69 and a brief touch of 41.23. That's what we're keeping an eye on at the moment. Our international portfolios are positioned well for some upside here, but we could see some sideways contraction over the next few months. We don't think that we'll hit that 4,500 black line anytime soon in the next 2 months. So we're in for a pretty volatile couple of months, and we'll get members through it as we have in the past.
Yeah, and we've also been on record to say, look, we do believe the second half of this year will be a lot better than the first half. There's a lot of inflation and interest rate information to be digested by the market. So yeah, in the short term, Ed, you're right. We do think we'll pretty much continue this volatility, but longer term, we suggest hold quality stocks. If you've done your research, no need to panic and continue to be in the market. ASX 200, on the other hand, Ed, has been actually relatively stronger compared to the rest of the world.
We are, and we've started to see trickles of international fund management money come in to our market. It put some pressure on the Aussie dollar, and the Aussie dollar was rising, and as that money came in, the Aussie dollar started to retreat, and the US dollar started to strengthen again. So it's pretty volatile at the moment. The VIX index is quite low at the moment. It's about 30 last time I checked it, which is pretty good. But look, we've got an election here. On top of that, we've got what's going on overseas as well, affecting the markets, inflation. Interest rates are going up, and there'll be back-to-back interest rate rises over the coming months. We know that already. The Reserve has already told us that's exactly what they'll be doing, but we're trying to predict by how much. So mortgage repayments across the country going up. So, really it's coming back to a defensive market at the moment. And I've seen the small cap sector absolutely hammered over the last month or so. And this is the key. If you're going to have, you need to have inflation hedge stocks. So these are stocks that do well in tough times. These are stocks that are infrastructure ready, balance sheets are well and truly in order, cashed up, and debt is low. That is the key in this current market. And that's what we're researching at the moment. That's what we're providing for our members. So our portfolio, actually, Roger, has come out of this quite well at the moment, as long as it doesn't go down too much further. Our income stocks are going quite well, and our growth stocks, most of them have done quite well because they're infrastructure ready. They're all built, and the miners are producing. Soft commodities are also producing as well, and we've got some inflationary hedge stocks that we can show some of our newer members at a later date. But yeah, it's going to be a tough couple of months. See that black line at the bottom? We're getting pretty close, 7,100. More than likely it'll drop below that from here on this chart, and that'll play out over the next few months. So we're in for a pretty rough ride from here till June.
Yeah. Again, but keeping in mind, we're not suggesting anyone to panic and to continue to hold your quality positions. But if you're obviously worried about any particular stocks, that you can look at them. But look, the ASX is obviously very different compared to the rest of the world. You've got financials and materials that are making a big chunk of our market, right?
Yep. The financial sector, which is obviously parts of it, will benefit from interest rate rises as margins improve. And you've got the materials sector. Most of our stocks are producers. We do have some explorers. Most are producers. Commodity prices remain high and elevated over the coming months, so we'll do quite well there. We are a bit under in healthcare on our end, our portfolios, but our healthcare stocks have done very well during this current period. And also discretionary retail, we're very low. They've copped one of the biggest hits in the current sell-off. Property stocks, we're well hedged there as well. With property, a couple of telcos. So energy, we've done very well, obviously. Across that sector, Roger, we've got quite a number of stocks been outperforming the market there. So, we're in a pretty good position, but financials and materials are the key. These two stocks need to perform, for us to have a turnaround in the second half of the year.
Absolutely. We'll talk more about that in just a moment. So let's have a look at a couple of things. But before that, obviously, the old saying, money never sleeps, and that's true. But personally, I love this line. It says, if you don't find a way to make money while you sleep, you will work until you die. And that's so true. And, money makes money. So if you can invest well, have patience, you can certainly do well in the market. So one of the things that our members love, and we're happy to share this today, because we have about 400 odd people watching this webinar. So this might be interesting for some of you who are interested in dividends. This is our income portfolio. Now, we're not showing the stocks on the left, obviously to protect the IP, but you can clearly see how it looks like. You can see the prices for the stocks, the dates we bought them, the current price, and the capital return, which is the growth, the income return, which is the dividends, and then the total return per stock. The key thing here is the 18.1% at right at the bottom right, 18.1% annual returns in this portfolio. Now, this is a defensive portfolio. Keeping in mind, they're all top 200 ASX companies. And to get that sort of return on an annual basis for the last 10 years in the market is quite remarkable. And a lot of our members, when they join us for the first time, they say, how do you achieve this return? What can we do to get a similar return? Because they love to have that. So Ed, over to you to tell us a bit more.
Yeah, look, this is one of our most popular parts of our Australian equities portfolio. I know a lot of our long-term members that I've been looking after tell me they buy all, at the moment, the composition is 22 stocks. These are all the stocks historically, so obviously we add and remove over time. But we're going into our 13th year, so we started this in 2012. So we pick what we believe are the most diversified 22 stocks. When we started, I think we had about 10, Roger, and we built it up to 22 stocks. I know some members have got some very large portfolios that have got all 22 stocks in there, and they follow it absolutely religiously. The income return is virtually guaranteed. Obviously, we went through a COVID period there in 2020 where income did drop. But again, we stayed in those stocks while the prices were down, and obviously we added a few along the way. And I remember when COVID hit, we actually added about 6 or 7 stocks in one quarter. We update this portfolio quarterly, every 3 months. It's a consistent performer. We've proven it over 12, 13 years. And this adds a big part of our Australian equities performance, which is about 55 to 60 stocks in total that we prefer in the market. And that's where we do all the legwork. We make it very easy for our members. All they have to do is follow that. Obviously, the larger portfolios can buy more, and the smaller have to be selective in this portfolio. But the income franking credits, not all 100%. Probably only half of those stocks are fully franked. Some are partially franked, and some are actually unfranked. And then we have some stocks like property stocks, for instance, that pay half yearly and yearly. That gives you a more balanced stream line of dividends coming through throughout the year. So you're not relying on all your dividends to come in March and September. They're coming quite consistently over, basically 4 quarterlies of dividend payments. And then obviously you can claim your imputation credits through the tax system as well. So this is the favorite part of our service, to be honest, for me, because I know most members make money out of this over a long period of time.
Absolutely. Look, if you're semi-retired or retired and you want those dividends coming in every quarter, every 6 months, this table shows you the net yields per stock. There's 22 stocks in this portfolio. There's a few examples you can see on the left-hand side. But you can see the gross yield, financial year 2022, and you can see a couple of them really standing out, pretty obvious. And then you can see the franking credits on the right. So we make it as easy as we can, but I think the key thing here is the portfolio average right at the bottom. You can see this is forecast to produce 6% returns in dividends alone, and the remaining 12% comes through growth. Now, these are not just defensive stocks, but there are also some growth in there. So overall, 18% a year, including 6% dividends and 12% in growth. So very good. If you're interested in getting a portfolio which can produce that return from one year to the next, do talk to us and stay tuned, because we've got some good news for you coming up shortly.
Yes.
Now, let's have a look at one of these stocks in the portfolio, Ed. Westpac recently reported their earnings to the market, and we've been on record for some time now to say Westpac is one of the most undervalued out of the big 4 banks in the market. And these numbers prove to be the case, because these are the half-yearly returns versus the previous half, and you can clearly see the numbers have been fantastic. It's actually better than the market expectations.
Yeah, look, there is going to be a challenging time going forward, but what we do know is their margins are going to improve. So if you look at their first half 2022 reported net profit, $3.2 billion, that probably includes a couple of fines, but the change is 5% there. So that could actually increase potentially if they can keep their costs down. I know there's cost challenges moving forward, expenses there, see the expenses there. They've got a tight grip on that for the last 3 quarters, $5 billion worth of expenses. There is a 10% change. But if you look at that 2022, 2021, the second one at 2%, they're doing pretty well at the moment. Their return on equity is 8.75 in the previous quarter. Slightly down from first half of 21, but with the margins increasing on loan repayments for their mortgage products, we expect this particular bank to do quite well over the next couple of quarters. But there are going to be some challenges ahead, and it just depends on any correction in the housing market, which will obviously affect their loan book. That's the key indicator at the moment, and that's one that all analysts will be watching for the next probably 12 months to see whether they increase, defaults increase or not. That's going to be a big indicator here. So it's not just about margins increasing, it's about the level of defaults. If they can control that and control their expenses, then we've got a pretty good business here in Westpac.
Well, something also to note as well, that the payout ratio from their profits is 60 to 75%, and the dividend yield, look, if you add the franking credits, it actually rounds up to about 7.2%, which is pretty good at current prices. Fantastic. And keeping in mind, this is only still 61 cents a share if you look at the last red little line there. And pre-COVID, they were paying 80 cents a share twice a year. So there is still room for the bank to improve over time. It's not going to happen overnight, as Ed said. There will be some challenges, but there are potential for higher net interest margins with interest rates rising now. So yes, this bank, can dividends go up? Absolutely. Can the improvement be made in the net interest margin? We think so. And if you look at the share price, well, look, we bought this stock a few times in the last 2 years. Obviously, May 2020 was a fantastic time. We bought it at $16. Bought it a couple more times, and we'll talk more about dollar cost averaging in a moment. But all up, look, we're up around 50% since the COVID times, and we're collecting dividends along the way. So look, at $24 or thereabouts, it's actually a great buy in our view. And the best times, this stock used to be around $40. So we do think, even though it might not go back there, but there's still potential. Now, one other stock we'd like to highlight for people, if you're interested in a top 50 company on the ASX, we believe that this is the most undervalued top 50 stock right now in the market. Now, we're not showing the name for this stock just yet, but we'll talk to you towards the end of today's webinar, and we'll provide that to those of you who are interested. But if you look at the overall financials of this stock first, just to build up a bit of a story, you can clearly see that from financial year 21 to financial year 2022, these are the recent results the company's announced. Everything is actually on its way up, including the total income, the net profits after tax. The financials actually look very good. And also keeping in mind, this company is actually in retail/property. They own a lot of shopping centers around the country, and you can see some of the splits across Victoria, New South Wales, Queensland, and other states. And again, you can clearly see month by month improvement. You can also see the sales growing up from quarter to quarter, from December 21 quarter to March 22 quarter. The total portfolio is moving in the right direction. All up, exactly what you want to see as an investor is what we've got here. Now, a few things to note. This is a top 50 ASX stock. Current yield is 6.2%. And this is the one thing which we like, is they're currently at a 20% discount to the NTA. Now, if you don't know what that means, it's net asset value. And what that means is if the business sold and sells today, what would they be worth? That's what NTA means in simple terms. So they're currently at a 20% discount to the net asset value. The market is discounting this stock. So this is an excellent opportunity. Now, the other thing is pre-COVID, this stock was trading at $2.75, and today they're trading at $1.81. So there is an upside potential of 50% growth in this stock plus dividends. So this is one stock we'd certainly like to highlight for you if you're interested. But moving on to commodities now. So Ed, commodities is something we're quite bullish on here at Fat Profits, and we want to talk today more about lithium and nickel, because they're the two commodities which have been really hot. And we can clearly see on the charts here, lithium has had a good run, and nickel's had a fantastic run. You can see on the lots of green there as well. But when we talk about lithium and nickel, what's the key, I suppose, highlight that the market's getting excited about?
Look, obviously, all the headlines now are about electric cars, battery metals. Battery metals is lithium, nickel, copper, rare earths. Basically, you've got Albanese coming out previously in his election spiel saying that he wants to build the batteries here in Australia, but I think he must be reading Motley Fool's marketing or something, because these electric batteries are actually produced by the manufacturers of electric cars. So I don't know if he's planning to build cars here in Australia. I don't think that'll be feasible, to be honest. But it'll be wonderful if we can do that one day. But the key is that we are lithium rich, nickel rich, copper rich. As you know, we're iron ore rich and pretty much every other commodity under the sun. But we are well positioned for growth. You can see that nickel chart there. We know that blip was a short call, but that all balanced out and it continued to consolidate and rise. So we're well positioned here in Australia, and we've done very well. David Lennox and the commodities team have done extremely well. We've had an absolute boom over the last 2 years. The main reason is that our stocks were well infrastructure ready, basically infrastructure ready, and they were also inflation hedged. So costs were down, production was up, and they're going to reap the benefits, and their balance sheets are going to be full of cash going into the rest of this year. And we're really excited about the reporting season in August that's coming up in the next couple of months. It'll be pretty exciting because these companies like Independence Group on the screen right now are absolutely cashed up and ready to ramp up production going into the next 24 months.
Well, they're cashed up to the point they've got an offer on the table for Western Areas as well. Want to buy them out.
That's
but
right.
This company, look, we've got to buy on this so that you can add this to your watch list if you like. They've got excellent operations across the country, as you can see on your charts. Big company now. They're in the top 100 on the ASX. And you can see on this particular screen the demand for electric vehicles. And it's currently showing a huge projection. And you can see the EV sales have doubled from 2020 to 2021. In 1 year, the car sales around the globe have actually doubled. And look at the projection. And if you haven't done anything about this, look, this is probably a wake-up call for some people who may be looking at it, thinking about it, we'll do it later. If you haven't done anything about it so far, well, you missed out on some absolute unbelievable gains. But there is still hope. If you're willing and open to take some action today, look, there's many companies out on the ASX that you can buy. But of course, you want to pick maybe 2 or 3 in sort of an early bird advantage, a bit like IGO back in 2 years ago. And we'll show you the chart in a moment. But look at the next 4 years worth of forecast for electric cars around the globe. And this is what gets us excited. And then you've got IGO, got an offer on the table to buy Western Areas, another nickel producer. And they've got an offer for $3.87 per share to buy them out. Once that proceeds, then Western Areas will combine with IGO, and that's expected to complete in June this year. So that'll become a formidable nickel producer. Now, if you look at the charts here, you can clearly see IGO. We first bought in $3.44, a bit of an early bird sort of advantage, only about 2 years ago. And as Ed said, in the last 2 years, these stocks have gone through a boom. And if you'd invested even a small $10,000 in this company, you'd be sitting on $34,000. Pretty good for a blue chip stock.
Yeah, right. Great success story, IGO. And we've had multiple buys there along the way. And I've got members telling me they've more than doubled. A lot of them actually saying, should we take profits? But if you look at the work in the pipeline, especially with this merger with Western Areas, we're absolutely recommend it as a buy now that the market's retreated a little. And we've got a bit of red there on the charts. So there's a window there of opportunity, but it is starting to get fairly valued at the moment, but there is a small undervalue presenting itself in the short term, and that's why we've got to buy in the stock.
Yep, absolutely. Thanks, Ed. So moving on, look, we've obviously, our job is to pick stocks, and that's what we get paid for, is to research and find good stocks. And last year, we were very proud to say, look, we picked 3 out of the top 5 stocks on the ASX 200 last year. Chalice Mining was the first, the best stock on the ASX, CHN, absolutely shot the lights out. And Hub24, number 3, was a financial technology company, and they had a fantastic run. And the 5th best stock was Orocobra, which is now called Allcam. So we managed to pick 1st, 3rd, and 5th out of the top 10 stocks on the ASX last year. It's not by fluke. Look, we have to call it as it is. The team's actually done quite a good job, and our members have benefited from it. So we're proud to share our numbers. But Chalice Mining, look, currently we've got a hold recommendation on it. They've got a huge portfolio of nickel, copper, palladium, and gold mines around Australia. And they had one of the biggest discoveries of palladium in Australian mining history ever in the Julimar project in WA. And that was one of the key reasons. But we've had several people who've actually bought this stock early in the piece, including this one here, Grant. And he's a young guy, Ed. I think I've spoken to him. I think a couple of our other team members, including yourself, probably spoken to his father-in-law, Ian. Look, what a phenomenal story. But Ed, you probably come across a few of these from Chalice Mining.
There's plenty of these. This is just one. So these members, obviously, they put up their own testimonials on product review at their own discretion. But this is one that we pulled out. We'd like to share it with you. But this young gentleman is off to a very good start in his investment life. You know, he started off small, and we're going to show you a strategy shortly that we've used over 22 years. He's put a bit more in at 18 cents. So he started at 12, a bit more at 18, put another 10K in once it reached $3.50, and now he's got a $500,000 investment. So look, not everyone gets it like this, but this is how money's made over time. You know, you accumulate over time. But Chalice is a stock that we covered for over 15 years in our mining report. So we didn't just stumble across it. So it hasn't done well until it took on this new project in Julimar, and obviously had the biggest strike in Australia in over 30 years. So we had the buy at the time at 12.5 cents. We backed it up with another buy later that year, and then really it was early 2020 that it just absolutely took off, and it kept going. So it's consolidated at the moment. We've got it on hold in the current environment. They actually spun off their gold assets as well into another company. So they're really focused on, you know, really their battery metal portfolio going forward. And we're going to see a bit more from this stock in the years to come.
Yep, fantastic. So this was the best stock on the ASX last year. And look, obviously, if you can get one of these, you know, happy days, of course. We all love to have a couple of these. Hub24 was the third best stock in the ASX, financial technology company, and we've currently got them on a hold. They've had fantastic run. The results have been great. They've won 6 years in a row, the best platform in Australia for financial advisors, voted by them. And look, this is used to be small cap when we first bought it, as you can see on the charts, $1.35 all those years ago. And look, over time, this has grown and grown, and now it's a top 200 company. And that's the key as an investor. It's not, you know, the money is not in trading, not buying today and making 5% and selling tomorrow and then trying to chop and change. The money is really in buying quality companies, having lots and lots of patience, and holding these companies for a long period of time, just like you're seeing on your chart right here. And at a small 10K, just a 10K invested back in those days would be today worth $175,000. And I know, you know, a lot of young people, you know, would love to do that. And, you know, I'm currently teaching my teenagers how to invest their money early in the piece, and how they can grow this over the time. By the time they hit their 40s, they could have, you know, a lifestyle of choice. And this is what we preach here at Fat Profit. So another example of patience, doing your research, and holding quality companies. Now, before we get into a couple more recommendations for you guys today, I know there's a few questions popping up, but one strategy which people joke about in the market is the Bhp strategy. And if you've heard about this, you're probably chuckling right now, but if you haven't, we'll tell you about this. This is the old saying. You can see this guy, what he's doing is pretty obvious. He's standing there praying. And that's called the Bhp strategy: buy, hold, and pray. Now, why this is a bit of a joke in the market is it happens to nearly all of us at some stage. You buy a company, it goes down, you say, okay, I'll hold, and it goes down further, and you go, oh my God, okay, what am I going to do now? And it goes down further. Then what do? Then you start praying. And we all have done that. It's I hope it can just come back to break even. I just want to get out and restart again. Now, when that happens, obviously there's a lesson in this. There's an opportunity to do better next time. And how can you do better? We'll tell you today. One of the strategies which we use is called dollar cost averaging. And as you can see on the charts, it's pretty clear. You average your entry on a regular basis. You buy a stock rather than buying in one hit and then buying and holding and praying. You buy that stock multiple times over a period of time, so that your average entry into that stock evens out. Whether the stock, you can see here, you buy them when it was on the top left, but you continue to buy that over time, that brings your average down. I'll give you another example here. So if you look at the meaning of, or the definition of dollar cost averaging, I'll just read it out. It's an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in their effort to reduce the impact of volatility on the overall purchase. Now, the purchases occur regardless of the asset's price and also at regular intervals. So here's another example. And now, if you had $800 to invest, this is just a simple example, at $10 a share for a particular stock, you can either do two choices. You buy them in one lump sum payment, you chuck in the $800, you buy it at $10 a share, not a problem. On the other hand, the green option is you buy in $100 lots every month for the next 8 months. And you can see the share price going up first and then down, and then it goes down for quite a long time. So the example above the line, if the stock is same at $10 in 8 months, you haven't made any money. But on the example below, if the stock's actually gone down a few times, the average cost is $8.16, and if the stock is at $10, you've actually made 20% return in 8 months. So this is just as an example on how this strategy works. But Ed, here's this particular chart. I'll let you explain this, but because this is showing the Dow Jones from 1929 to 1954, so a period of 25 years when the Dow Jones actually went down and then literally came back up, flatlining in those 25-year period. So the difference here is obviously if you had invested $10,000 per year, every year for these 25 years, that's a total sum of $260,000 you would have invested. It would have compounded to $1.5 million if you continued to do dollar cost averaging. But if you didn't, if you just bought it in 1929 and then you cashed it out in 1954, you wouldn't have made any money because it would have just flatlined. What do you think about this, Ed?
Yeah, this is the key, and this is our strategy. You know, we've been doing this for 22 years. There are certain stocks that we've held long term, and obviously we buy in on the mini crashes or when the particular stock becomes undervalued. But this is the power of compounding. You know, you speak to anyone that's made money, whether it's the stock market or property, you know, you've got to buy well. And if you buy well, you hold. And we just spoke about earlier our income portfolio. You know, you got members that paid, you know, in 2016, I bought BHP at $15. So they're getting dividends on $15, not $45 or $46 or $47. So this is the power of return. It's the same with property as well. So, you know, the only way you get those big returns is riding the waves. You can see the waves in the blue chart. You've got to ride those waves, and long-term investors are still here. The short-term investors, they come and go. Now they're chasing a quick buck, and if they don't get it, they'll cash out and out they go in the back door. So the power of compounding, we show our members, you know, how to invest long-term, what to do during the mini crashes in the market, and also what to do when we predict that there's an uplift in a certain sector at a certain point of time. And we've seen that recently with obviously with commodities and soft commodities, and now we're starting to see pockets of the financial sector that could move as well. So, you know, it's about, you know, planning ahead, holding long term, adding to your investments over time to the same investment, and building a huge position, and you cash out at the end.
Yep, very good, thank you. And these are the things that we talk about with our members on a regular basis. So here's a classic example: Fortescue Metals. You know, this has been through ups and downs, as you can clearly see on the charts. We got in at $20.53. That was our initial buy. So some might say that was a bit late. Okay, fair enough. Ideally, you'd love to go back and buy at $2, but the stock went down. So what do? We didn't bail out. People were worried. We actually bought it again at $14, so that brought our average down. We bought it a couple of times around $15 and $16 as well. So our average on this stock is around $17 a share, and the stock's obviously now gone up a few times, but also paid nearly $3 plus in dividends. So $17 average, we've collected $3 plus in dividends in the last 9 months, and actually we're sitting quite happy, and we'll just continue to accumulate. We're not in it for the 9 months or 12 months. We'll be holding this stock for years, and every time it drops, you accumulate, you dollar cost average, and these are the kind of opportunities that will present themselves. Now, the old sage Warren Buffett, you know, arguably the best investor in the market, achieving 25% return per year for 40 years running. You know, you can't argue against that. So he says the stock market is a device for transferring money from the impatient to the patient. And we all know this. We've all done it before. I know I have. When, you know, you lose patience on a stock, even though you know they might turn around in the future, and you give those stocks away to someone else, only to see the stock then start to rise. And then you go, why?
This is where the fund managers make their money, Roger.
Yeah.
You know, the retail investors usually sell on emotion. And then when the market's at a tipping point and it's about to turn, it's the fund managers that come in and snap up all that, undervalued selling, I guess, from emotional investors, and they're able to build a very large position early, and they'll cash in generally. So our job is to get that information to our members and making sure that we're in the same trajectory as the fund managers, and that's why people like Warren Buffett do very well over a long period of time in the market, because they're buying all that value that's been presented purely because investors have become impatient during a mini crash or any other period in the market.
Yep. All right, excellent. Now, how do you make big money? Look, we've talked about this plenty of times in the past, but if you've never watched our webinars, you would know that we're not buyers and sellers of stocks. We don't buy and sell, we don't trade. We do buy stocks and we sell them at some stage, but our big money that we will make it is we follow Warren Buffett's principle. We hold stocks for a long period of time, and that's how we make money. So we urge you, if you're watching this today and you've traded before and you thought about trying to time the market, we urge you to rethink that strategy, buy quality companies, buy them early, hold for a long period of time, keep a look at, keep an eye on these stocks, watch their announcements, read their balance sheets. And if you can't do it, that's fine. Pay us. We will do all that for you, and we'll keep on updating you, so that if there's any alarm bells, we will notify you. Now, most of you watching this today, there's about, like I said earlier, there's about 400 odd people watching this. I can see that right here. Most of you would know who we are. We're not stockbrokers. We're a stock market research company. We don't, trade for you. You buy and sell, you sell. We simply provide you all the research. We keep you informed. We educate you. We support your decision making. But you do all your buying and selling yourself. Now, Ed, just a couple of minutes of a bit of background would be great.
Yeah, that's right. Look, essentially we're stock pickers at the end of the day. We're picking stocks, and we're market predictors. So on a daily basis, we predict the market. We don't give you the market news. And on a weekly basis, we update our members on a number of stocks that we researched during the week from our current portfolio. Occasionally we'll add a stock, occasionally we'll remove a stock, whether it's taking a partial profit or selling. But basically, we're a service for self-guided investors. We have an office in Sydney. We have an exposure in our London office as well, and our Auckland office. We are global. I just signed up a guy from Kazakhstan earlier this week. Last week I signed up. As soon as I got back, I had an email from a guy in the Czech Republic, believe it or not. So there's people all over the world using our service, and these people manage their own investments. A lot of them are expats, originally Australian, investors here that have moved overseas for work. Dubai, for instance, we have a lot of members in Dubai, and they still stick to the Australian stocks, but once they go to these countries, they start to diversify. They start to say, well, I am seeing a lot of different companies where I work that I've never heard of, and they start to look for research on those companies, and they start looking at our global equities portfolio, and in particular our UK equities portfolio, which has been outstanding this year. I mean, that market really has turned around from its COVID lows. So our UK portfolio has done very well. So we've got a global reach, self-guided investors, even though the bulk of our members invest in Australian shares and have an Australian share portfolio. Some of our members have larger portfolios, so they need to diversify outside of Australia, and we can provide you with that. And also our account management service. We have real people here, phone support, email support. We can give you answer your questions throughout the year. So we're not just an online, marketing tool. We're not a direct marketing company. We've got real people here. I've been here going on 12 years now. I had to put off my long service for almost 2 years, which I just came back from, and looking forward for the next period. But, we're here to help. And we've got Angus here. He's been there from day one, 2000. David Lennox has been here pretty much from the start. A lot of our senior guys, myself and Roger and Cheyenne and so forth, been here for well over 10 years. So, you know, we're happy to look after you moving forward. So David Lennox, very trusted in the commodity space. There he was on Ausbiz again this morning. He's on there regularly. They ask him for his comments in the commodity space. So he's got a very wealthy track record. He's with Colonial Mutual Life. You can see there Norwich Union Life. So some of these names are very old. So he has been here for a very, very long time. And he's very well trusted, and he's picked all those winners in our mining report, you know, one after the other.
Yeah, not giving his age away, Ed, but yeah, David's been around long enough, and yeah, he's been with us for over 10 years as well. He's our resource analyst, so all mining stocks come from his team, and he's very, very popular with our members. And finally, look, we're not just stock pickers. We also manage real money, and we have a wealth management division, which is headed by our CEO, Angus Geddes. He is a fund manager, and the orange line you can see is a comparison between the ASX 200, which is the black line, and the orange line is our funds in the Australian market, and we've been outperforming the ASX 200 pretty much from early days till now, and the gap's widening, which is very heartening. We've performed at 300 odd percent the portfolio since inception, where the market's done 122%. So we nearly triple the market. And look, we say that with a lot of pride because it's not hard. It's not easy to achieve that. Most people struggle to just meet the market, which usually goes at about 7 to 10% a year. Our portfolio's tripled. This is real money, and you know, a lot of our members absolutely love it. So let's talk about the next section now. We talk about soft commodities briefly earlier. Look, obviously, you know, agricultural commodities have had a great run thanks to multiple global factors. You can see some of these soft commodities on your screen, and there's been an inflation of food, which we're all feeling in Australia and around the globe, thanks partly to the Ukraine war, and we can feel all that around when we go grocery shopping. Prices of wheat, prices of coffee, prices of beans, and everything else that you can think of has gone up. Now, we've got a number of recommendations in our soft commodity space. We've covered a couple of them in the last 2 or 3 months, and giving that away as a free recommendation. Here's another free recommendation for you while you're watching this webinar. Is Australian Agricultural Company, and we've got a buy on them. They've had a pretty solid update recently to the market, and here you can see some of the numbers on your screen. The cash flow has improved 22% versus the previous period. All in all, if you look at the net value of their balance sheet, it's actually in better shape than it was 6 months ago or 12 months ago, Ed. Anything else that you think might be worth pointing out?
Yeah, it's a classic turnaround story. You know, there's a company that used to bleed money. Now they're reaping the rewards of a sustained growth period over time, and the prices of their product, which is obviously cattle, has increased dramatically with this food inflation environment. But the net tangible assets is a key one, $1.88 per share. It's up 7%, and they've got cash on hand now. So again, this is the company that had no money in the bank many years ago, and now they're well and truly cashed up. So we see that as an opportunity going forward. It's held up quite well in the current environment, and we'll give that away as a free recommendation. But obviously, we'd recommend to read the research first before you buy any stock. And this is where our research service will benefit you as a self-guided investor.
Absolutely, thanks, Ed. And this has gone up 50% in the last 2 years since our buy. So 50% in 2 years is actually pretty good. You take that any day. Now, not only we tell you what stocks to buy, but we also tell you which stocks to avoid. So we'll just give you a small selection of a few. And the first stock we would suggest to avoid, and we've been suggesting that to avoid for some time now, is a company called A2 Milk. Some of you would be familiar with their products because you buy them in Coles and Woolworths. And the chart looks pretty ugly. So if you're holding that stock, look, our apologies. We don't want to rub any salt in your wounds, but this stock has been underperforming for some time, partly thanks to China. That was the biggest customer. China's imposed big taxes on Australia since COVID, And look, if you were holding that stock, there were red flags right then and there when it was trading around 18, 16, $15. We were on record at the time to say, avoid this stock. There's a big turnaround they need to find a bigger customer than China. And to date, look, they've been trying, no doubt about that. They haven't found it. The stock's just getting smashed. It's now down to $4. So anyone who bought it at around 15 or even $10 or $9 thinking it's cheap, just purely based on charts or purely looking at technicals, would be suffering right now. So it's important that you understand where the business is going, understand where the competition is going, and where the next big customer is coming from. At the moment, there isn't, so you must preserve your capital, avoid these kind of companies. Another stock we've been saying for quite some time to our members and of the audience is avoid AGL. Now, recently, they've had an offer to be bought out, but they've rejected that offer. Well, that's pushed the share price up a little bit up north from $5 to around $8. But all in all, look, it's a pretty ugly looking chart. And this company's got huge issues. We've been saying avoid for some time. So currently we're still suggesting avoid, even though there is some hope there. But until there is some clarity, until we see some real substance behind the turnaround, we would be avoiding this stock as well. Next stock is
Mr. Cannon has a lot to do with that share price.
That's it. The billionaire, he's put it up.
When they start buying, people just go in just because the billionaires are in there. But that's an interesting one, definitely, AGL.
What about Zip? I mean, this stock has gone from $12 to $1. I mean, this is unbelievable.
Look, terrible performance. Look, the deal with Sezzle, we believe, is still on the table. But during many crashes, these high growth stocks, which unfortunately aren't making any money at the moment, they did a capital raise at about $1.40. And those investors are already down on their investment. Look, potentially could be a turnaround story in the future, but we generally just don't go into these depressed assets. They're just too high risk for us. But if you're a punter on the horses or a gambler, you might put some money into this type of stock. It could turn around, it could not. I had a member at about $1.70 say, even my son told me, he goes, this stock could go to $5 or could go to 70 cents. And that was about 3 months ago. So his son, who, as he told me, knows nothing about the market, even he could work out that, it's either going to be a boom or bust on this particular stock. So anyway, time will tell, but it's just not the type of risky investment that we would go into.
Yeah, absolutely. The stock needs some substance. So the last stock to avoid today, and we won't spend too much on this, Magellan Financial Group. Look, this is a stock we know quite well. We bought this early in the piece, as you can see, and that's where the real money is. You've got to buy these stocks early. And we've said that a couple of times earlier in this presentation, is early bird gets the worm. So we bought this at $1.74 when they were a small cap. And we saw the potential, we understood the business, we went to their meetings, and we got the full gist of where this company could be headed. We put money into this stock and rode it all the way to $25, made a huge gain of 1,600%. Look, some might say you sold a bit too early because its stock did go up to $65, $70.
Yeah, we did sell a bit too early, but we made a lot of money out of this stock. And I know members that bought it who made, you've seen there 1,600%. So at that $25 level. So, but look, this particular stock, obviously they've lost their major client. That's 15%. They've lost the CEO. It all depends on funds under management. So we'd rather go with Hub 24, which we know funds under management are increasing year on year, and it's just a cash cow basically. So why would we risk it on a potential turnaround story that may not turn around for a couple of years, to be honest, if any? There are much better businesses out there at the moment. So we're not going to catch a falling knife on this one, and we're going to keep the avoid recommendation on this stock.
Yep, absolutely. Thanks, Ed. All right, let's move on now to some sell recommendations. So far we've given you a few buy recommendations. There's a hot buy coming up, reminding you again towards the end of the presentation. So we've given you a few buy recommendations. We've given you a lesson on dollar cost averaging. We've talked about stocks to avoid. Now we're also going to share with you stocks that we have sold recently. You can see about 12 or 13 stocks that we have sold. And now On the right-hand side, you can see the 10,000 investing. We normally use that as a bit of a benchmark, what that would be looking like when we sold it. Lots of green there. Look, the best one is mainstream. The 10,000 would have turned into 47,000. In fact, ARB, my apologies, that's probably the best one, 54,000. Look, there's a couple of losses there. Just proves we're not gods, we're not perfect. We do get a few wrong, absolutely, like anyone else. But most of them have done quite well, and our timing has been pretty good. But on an average, we'd probably do one sell recommendation a month.
Yeah, we've got some good timing on this one, Rog. In particular, Domino's Pizza at 105. It was in the 60s range recently. Platinum Asia, we got out at the right time. China A shares, all before the Asian correction. Sonic Healthcare at the top. Mainstream classic play, that one, takeover offer. And we've done quite well. Vocus and Boral, Omni Bridgeway, all classic. The only ones obviously we got wrong were Decmore and Saver Group, which was a risky play from the start, but it didn't pay off. But some of those small caps is where you generally, if you are going to lose money with that profits, the occasional small cap, but you'll make it tenfold on all the others. You can clearly see there, it's the 80-20 rule. Get 80% of your portfolio right, it'll more than cover you for the 20% you get wrong.
Very good. I like that one, Ed. Well done. Now, let's have a look at our overall results, because I think that really is what people are interested in. And normally when we share this screen, we start to get a few questions. People start to sit up and pay some attention. Because really, the reason you're watching this webinar today is you're looking for an edge. You're looking to find something which can help you make money. And look, nothing better than seeing these type of results in your own portfolio. And if your portfolio is currently flat or a little bit down, look, it might be time for you to change something. And we're here to encourage you. We're here to motivate you to make that one little change. Now, how that will happen is, let's have a look at the results first. Now, these are our overall results from 2000, when we first opened the business. Our average return per year is just shy of 18%. Let's just call it 18% per year, versus the market, which has done 8.5% per year. So that's an outperformance of 9% per year. Now, some people don't even get 9% per year on their own, let alone beat the benchmark. So if you got to ask yourself the question, I suppose, is what are your annual returns? Do you know your returns? Are they 5 to 10% a year? Are they closer to the 10% a year mark? Or are they closer to the 15% a year mark? Look, the bottom line is, if they're not anywhere near 18 to 20% a year, then you must do something. Because if you keep doing the same thing over and over again, you are going to get the same results. So having said that, we break down our results per year. You can clearly see that. I don't need to explain that. Our best work really is when the markets are down. And you can see that in 2015, when the markets were down, our portfolio was absolutely gunning up 18% in that year. So that was the best year, in my opinion. Also, 2018, the markets were down. We again outperformed the index. All in all, we do a pretty good job. Look, we don't get it right every single time. 2019, the markets did 24%. We did 19%. So yeah, we underperformed the index in that particular year. So look, we will take it absolutely on the chin. But all in all, you can see on the right-hand side, we've been outperforming the market in teenage numbers on a regular basis, and that is absolutely phenomenal. Now, just to show you a little bit of a compounding interest slide, if you invested $10,000 back in the day in 2000, and then you topped up that portfolio with just only $5,000 a year for every year for the last 20 years, just to show you the power of compounding return. This is what I'm showing my teenagers, by the way, is that if you invest your money now, and they're starting to buy a couple of stocks, but you do it regularly, and you just let it sit there, compound over time, in 20 years, you could be sitting on $1.6 million with just $5,000 invested. And I'm encouraging them to invest, obviously, a little bit more with time, and for them to reach 40 and be financially independent. And that's the principle that we follow. That's the principle Warren Buffett has taught the rest of the world, and we teach our members this on a regular basis. Now, Ed, over to you. There's some reviews from real people, real members, to also provide a bit of value for their money.
Yeah, absolutely. These are real members. We've most of them managed around SMSF, and we just selectively pick them out of product review. We've worked very hard over the last 3 years, Roger, to get our business to where it is now. You know, we are a leader in the industry, and we're generally a go-to for new investors. And most current investors in the market use our service, especially if you've been in it for 10, 15, 20, 30 years. Most of them subscribe to our service. So, but it's the new investors that can come in and get off on the right start. You know, there's a lot of people that come into the market and they get it wrong for multiple reasons, probably because they're getting the wrong information, you know, word of mouth, or just joining marketing companies, you know, for $100 or $200 a year, and just buying 1 or 2 stocks, getting it wrong, shut up shop and leave, pack up and go. They generally miss out on all these returns that we've showed you in this presentation. So these guys have been with us for years and years. He's one. The reason we picked that out is because this gentleman actually told us in his review that we reviewed there on product review that he was a former stockbroker. So, you know, Angus's views on a daily basis, it gives you the macro, it predicts the market, highlights a few stocks in multiple markets, not just Australia. Big focus on the US there. But this is one of our most popular reports because most of our members don't chop and change their portfolios like stockbrokers do. And they get those returns over time. So Penny, again, another one, been with us, I think she's been with us for longer than that, but anyway, 8 years. You know, she's done very well. I know for a fact she's done very well out of fat profits. She's got some of those big winners that we showed you. You've only got to pick 1 or 2 of those, and it just makes it all worth it. Makes up for the rest. So, you know, these are real people, real reviews, all self-guided investors managing their own money, their own investments, and they use us as a guidance in the market. They use us for our stock picking, and some use us for our market predictions on a daily basis, and others use us for our stock picking that's updated weekly for the members. You can use it whichever way you like. And then some members use us for our support service, you know, to give us a call on the main line, ask those questions, or call their account manager, ask those important questions. Many reasons to join, as you can see on the chart there. So our performance on average is 18% per annum over 21 years. Our job, well, our service essentially saves self-guided investors time on research, so you don't have to look around for information, in particular free information. It's the worst information to act on, to be honest, unless you've got the research to back it up. Experienced and reputable management. As I mentioned before, you know, most of the people that work here at Fat Profits, a lot of them have been here from day one, especially the ones that write the research that go out to our members. Angus, David, Lennox, and the research team, they've been here for pretty much from the start. 7 out of 10 winners. It's back to that 80 or 70%, 30% rule. Even if you get 70% right and 30% wrong, I generally focus on 80-20, but if you get 70% right and 30% wrong, you will make money in the market over a long period of time. No direct marketing here, you know, no fancy headlines, no upselling. There's one membership which covers, you know, certain reports, and then there's another membership that gives you a couple of extra reports, and that's it. You know, you don't sign up to a cheap marketing email, and then there's a long-winded email that comes out after that, getting you to sign up to another one, and all of a sudden, you know, there's 12 different products. That's not what we do. Okay, so we are not direct marketers. We consider ourselves as, you know, not sophisticated investors, but professional investors and savvy investors, because of the information and knowledge that we provide to our members. Okay, and we manage real money. You know, most people don't realize, the reason we're the leader in the industry is because we manage up to $1 billion in funds under management at the moment. So we've got 9 managed account portfolios. You know, we've got 4 research portfolios as part of our subscription service. That's the one for you guys on the webinar today. And then we've got listed funds. We've got a property fund, we've got a contrarian fund, and we've just got an ETF that's been listed on the ASX, FATP, which provides units, new units, so you can invest in that from scratch and you create your own units. And the valuation of the units is to NTA, net tangible assets, so it's true valuation. So if you decide to sell in the future, you're selling at actual valuation, not share price, which is the problem with a lot of LICs. Yep. It trades at the share price, not the valuation. Yep. They're basically the reasons to join.
All right, thank you, Ed. Look, lots to think about. So what we're going to do today is we're going to give you an opportunity to get involved. Again, if you're open-minded and you're willing to change, you're willing to take the next step, to try something different. No, we're not asking you to marry us for 30 years or 40 years, and we're not getting down on one day and proposing for a lifetime commitment. We're just asking for you to try us for a couple of years and see if that makes a difference. And in order for that, we've got three options for you. We've got a standard membership, we've got a premium membership, and a platinum membership. Now, regardless of all three, whichever one you decide to go with today, they can all be tax invoiced to either your self-managed super fund or your business name or your own personal name, whatever you like, and they are fully tax deductible. Of course, you've got to speak to your accountant, but in our experience, nearly everyone claims this as a tax expense. Now, the difference between the three, so I'll just explain so you understand it clearly. So the standard membership, premium, and platinum, all three, the first three benefits which are listed here, they're common in all three. So I'll highlight that first. So the daily Fat Chat market commentary, that's an email which you receive every morning before 10 a.m. It hits your inbox straight from Angus's inbox, Angus's email. So he's our CEO. He writes every morning, Monday to Friday, 5 emails per week to our members. And that is a market information every day about what's going on around the globe and especially here in Australia. So that will be the first thing you'll receive with lots of good quality information. Secondly, you get a weekly members only webinar every Thursday at 12 p.m. for 1 hour. Now that's live and interactive with our panel of analysts, including Angus, David, and plenty of others, Andrew, Andre, Sandy. Lots of our analysts come along, and for that 1 hour, we discuss about the Australian market for that week. We cover 15 to 20 stocks every week. We tell you which ones to buy, hold, sell, and avoid, and we take questions from members live. It's one of the best things you can do for yourself is take 1 hour a week out of your busy life and watch that live webinar. And if you miss the live webinar, that's fine. You can replay the recording later on. Not a problem, but that will be well worth your while and will give you lots of ideas for you, which you won't be able to find otherwise. Third benefit is Friday Fat Wrap, which is a wrap up of the week and any major highlights that you may have missed out in the week. And we email that to you every Friday evening. Okay, so those three benefits are common across board. The difference between standard, premium, platinum is with standard, you get access to one of these 4 reports. At premium, you get 2 reports, and platinum, you get all 4 reports. So the reports are Australasian equities, which basically includes Australia, a little bit of New Zealand, and a little bit of Asia. Mostly Australia and the stocks that we cover here. So that is a must for Australian investors. Second report we cover is global mining. That covers all the mining stocks from our team. So if you're interested in mining, you must have that. And now don't be fooled by the global word, because 80% of the miners here are Australian mining companies and 20% are international mining. So most of our local miners here in Australia. And then third is global equities, which means international markets, including US, Europe, and Asia. So if you're interested in those markets, you can subscribe to that. And fourth and final is UK equities, which is obviously for the UK market. So the difference is, if you're a standard member, you can pick one out of these 4. Premium member, which is very popular with our subscribers, you can pick 2 out of the 4. Plus, with premium, you also get a premium account manager, and that means you've got the ability to call or email and speak to someone to talk about stocks and talk about markets. And that's very handy. And last but not least is platinum, where you get all the 4 reports and the account manager. So just to give you a bit of breakdown, 70% of our members are premium members and 20% are platinum members, and only 10% are standard members, because the price difference is not that much between these next levels. So that's hopefully gives you clarity. Now, before we look at the prices, I just want to show you one sneak peek of our members area as well. So this is how our members website looks like. When you become a member, you'll get your login and password, and then I've logged in here, as you can see. You scroll down there's a video there for you as an introductory video. And then you can see our research products. So you've got Australasian equities, UK equities, and I'm clicking on them, global equities and global mining equities. So depending on your level of subscription, you will have access to them. And these tabs right next to them, they have got all the information. So you've got the latest weekly report, which comes out every Tuesday with 4 to 6 stocks per week. And we tell you buy, hold, and sell, and there's a report on each stock. Second is you've got new recommendations. So there's a list of about 20 to 30 buy recommendations. Instantly, you will log in and see them straight away. And there's bound to be a couple that you will like. Our Fat Profits portfolio, which has been generating nearly 18% returns. You can see that past recommendations, all our winners and losers, they're all listed here. Any alerts that come through on a particular stock, we will send to your inbox midday, and you will receive any announcements while you're out and about. So we're the eyes for you. Now for dividend investors, we've got the income report, which is the one we showed you earlier, the 22 stock dividend portfolio producing 18% returns per year. So that's found here. We update that quarterly. Remember, it's updated only quarterly, so you don't need to sit in front of the computer every day. And last but not least, our webinars for members every Thursday. They are recorded and they are placed here. So you can replay the recording from here, or you can watch it live, either or. All this is available, nice and easy to use. Now, I'm going to go back to the pricing because I think that's what everyone's waiting for, is to know.
Just on that,
what,
just on our members area, the one thing investors on this webinar today would have noticed, there's no advertising. Unlike other services or any of our other competitors, there's no advertising here. There's no data feeds from the ASX or any other provider, no ads for foreign exchange or crypto. Other companies that provide, watered down services, which mostly provide insights and articles in the market, they get paid every time you click on those ads. So even though you go into their members area as a subscriber, if you click on a Forex ad or a crypto ad, they actually get paid, I don't know, $20 per click or something like that. So from day one, from the year 2000, there is no advertising for any other external marketing company or service or provider or broking platform on our members website. Our members website is purely for our subscribers and our members. And that's where we store all of our current and past research, including all of the archives. So going into the subscription offer, Roger, go ahead. Yep.
So we've got a special offer for the audience today, and these are the 3 prices that we've listed. So we've got the standard membership. It's normally retails at $1,095 a year, and we've got it down to $895. So we've got a $200 discount there. So if you're interested, that's an easy, nice and easy, simple membership. Premium, which is going to most likely get the most attention today, that is retails at $1,545 a year. So it's not a huge price jump, and we've got special offers today. So the first one is 1 year, which is $400 discount, $1,145, and we'll give you a tax invoice. The real juice is probably for better value for your money is in 2 years and 4 years. And if you're willing to commit for 2 or 4 years, that's where we're going to give you the absolute bang for your buck. So if you look at the 2 years, it's down to $899 a year, which is fantastic. And the 4 years at $2,995, it's down to $749 per year, which is obviously not a lot of money in the stock market. $700-800 is nothing, because you can easily make that back in one good idea, whether it's a Chalice Mining or a Hub 24. Now, Platinum, on the other hand, that retails at $25.90 a year, and we've got some excellent prices here. The 2 years is down to $14.99. So that's $1,000 a year discount, and the 4 years is absolutely phenomenal. That's a 60% discount, $1179 per year. So the 4 years is definitely the way to go, and we know from experience people want to get the best value for their money, and that's when they say, look, lock us in for a period of time. Now, Ed, but wait, there's more, because I think the 4 years, you've got something to announce on that.
Yeah. Look, the Platinum members, even our current members, when they renew, a lot of them go for the Platinum option because they get an annual portfolio review and myself and Roger do most of the reviews after we get some notes from the analysts. So that's a very popular option. So you can send in your portfolio once a year, and some people sell it before tax time to see if they want to make some adjustments and do some tax time selling, or basically just send it in when they feel like the portfolio is not performing as well as it could, and you get a second opinion on all the stocks and the diversification of your portfolio. So it doesn't matter how many portfolios you got. I just did one gentleman had 4 portfolios, so I understand why he renewed it for a platinum membership, because that would cost him a fortune if he had to go through a financial planner and get a statement of advice. But it was a pleasure to do that review, and you really appreciate it. We cleaned up a lot of, I guess, a lot of dead wood, we would call, in the portfolio, which gives him a fresh start for potentially the second half of this year. The premium membership, look, if somebody wants a portfolio review as a one-off, you know, look, if you take out the 4-year membership, we can justify the time that we spend on that with you. But we can't do the review as a new member until you've been with us for 30 days. That's the rule. So once you've been with us for 30 days, you can send in the portfolio and we'll get a review done. And we'll organize that. Otherwise, we can discuss it over the phone. We'll work something out. It's not a problem. But look, the whole idea is that it's exciting to present this to you today, where we believe we're getting close to the bottom of the market over the next extended period, the next month or two. So there are going to be some pretty exceptional buying opportunities that we can present, and it's a good time to join if you're looking to put some new money in the market. So if you're ready to put some serious money in the market, whether you're a current investor or you're a new investor to the market, best to get the advice before you put that money in the market.
Okay, great. Thanks, Ed. So just to clarify, so you've got an option on your screen right now where you can make your selection on which membership interests you. So we've got the standard, premium, or platinum. Just to clarify, because I've just got a question from David. He's saying, so the premium membership gives me one-off portfolio review, is that correct? And the platinum gives me an annual portfolio review. So David, yes, you heard it correctly. So if you go for the premium membership for 4 years, you'll get a one-off portfolio review, which we'll conduct in your second month of joining. The platinum membership, on the other hand, if you go for the 4 years, we'll do an annual portfolio review every year for the 4 years. So that's certainly got better value for your money. Now, we've also got a question here from Margaret here, Ed. Margaret said, I'm an ex-member and I tuned in today because I'm a bit worried about the current state of play. My portfolio is down a fair bit in the last 2 months, and I was wondering if I should sell now, given May is a bit of a weak month, and maybe rebuy in July or August. What's the panel's thoughts?
It just depends on how risk averse you are. You know, if you can't afford to lose the money, if you're playing short term and you can't afford to lose the money, to be honest, it's probably too late to sell. You should have done that when the correction started, which is about a month ago. But as we proved today, well, as we showed you today, you know, historically, now's not the time to sell. So you just got to bite the bullet. Firstly, you got to make sure you got the right stocks in the portfolio. That's another reason to join, and review our preferred stocks in the market. So again, we're not a database here. We don't provide you a database on 2,000 companies and star ratings. We actually select the stocks that we believe are the best stocks in the market to invest in, and then we provide regular updates on those stocks, whether it's time to buy or continue to hold, or it's time to sell. So we'll give you those ideas, but yeah, generally, we don't think now is the best time to sell, unless you absolutely need the money, but you might regret that decision in a couple of months.
All right, thank you, Ed. We've also got a couple of comments coming from Tia in Brisbane saying, excellent presentation. I've learned about dollar cost averaging today, and also having a bit more patience, and certainly stocks to avoid. So thank you to both of you. Well, Tia, you're most welcome. We've also got a comment here from Jonathan saying, in fact, more like a question. He's saying, I'm interested in joining on the platinum for 4 years. I've got a self-managed super fund, which I've been managing for many years, and I want to get that annual portfolio review because it's time to make some change. So the question he's asking is, how do we get to sign up? So there's a simple answer. Jonathan, is you just make your selection on the question on your screen, and we'll get in touch with you later on today or tomorrow, and depending on the responses. But I can see on my screen there's quite a few responses coming through, so we'll just get in touch with all of you who's showing interest. And look, we do congratulate you for taking part. For some people, look, we can't convince everyone. Let's just be honest. Some of you probably just looking for free information, and you've probably seen these webinars before and maybe never want to pay. Maybe you've got an allergy or your doctor's advised you not to ever pay for these services. So, you know, we understand, that's okay. But we're happy to help. If you picked up something from the presentation today and you know, you're better off for it without having to pay anything, you know, you're welcome, not a problem. And you probably will make money from some of our advice. But for the others, look, it's a bit of an appetizer. It's a bit like we're running the restaurant inside and we're standing outside with an appetizer to say, here, taste it and see what you think. If you like it, you can walk in. So if you like what you're seeing so far, if you like our results, please walk in and you won't be disappointed, because we've been, you know, preparing these meals for years and years, and we've got reviews from other customers who've been very happy. So for those of you who are showing interest today, you're welcome.
The membership pays for itself. It's one thing I've learned over the last 12 years here. It absolutely pays for itself. And when you see some of those examples we gave you today, it's an absolute no-brainer. It will pay for itself, but you won't know unless you try it out for yourself. And if you do try it out, you'll probably buy a couple of stocks off our recommendations, and you'll probably make a lot of money, especially where the market is right now.
Absolutely. You got to be in it to win it. So here's the last stock that we will be giving away today. This is very exciting stock, and we'll tell you why. For all those of you willing to join today and you want to be in it to win it, this is a nickel company based out of Western Australia. Here's a picture to give you a bit of a background. But here's the key highlights. So if you look at the financials, you will clearly see from, you know, financial April 21 to April 22, the revenue's gone up, the pre-tax mine cash flow's gone up, everything is on its way up. The financials certainly look good, but the other thing which we like about this company is that the market cap currently is around $600 million. So they're a sort of a mid cap, if you like. They're into nickel, copper, cobalt, and they're obviously in Western Australia. Now, the beauty on this particular mine is that the all-in costs, which is basically the whole cost of producing nickel, is $6.36 per pound. And do you know what the price of nickel right now is? It's $19.92 Australian dollars per pound. So you can, it doesn't take a rocket scientist to work that out. The cost of $6.36, that's what it's costing to produce nickel, and to sell it is $19.92. So the difference is the margin, the profit margin, which is quite substantial, as you can see. But more importantly, it's expected to grow because we are confident the nickel will actually continue to go higher. So the margins are expected to grow higher, and the production, they're not even in full-scale production yet. They've only just started producing in the last few months, so they're still ramping up their production. If you then look at the share price chart, and Ed, I'll pass it on to you to say your final words, but the chart looks pretty good.
Yeah, infrastructure ready. It's what we spoke about earlier. Yeah, this isn't a WA Explorer that hasn't dug a single hole in the ground for infrastructure. This is a company that's producing at current elevated levels or record levels of commodity prices, which we're predicting to go higher. So the cash flow is going to increase, the profit's going to increase, and look at the share price. It's only around, what? It's just come off 37 cents, so it's even less than that. It's around 30 cents at the moment. So infrastructure ready, and this company, when they start delivering their results and show how they've grown their balance sheet, that the share price could go to anything. So the fund managers catch on to these ones, the share price will rocket north. So the reason we're presenting these types of opportunities, and as we did earlier this year, every single hidden gem that we presented in the last 12 months, Roger, has gone up, stayed up, and continues to go up. It's as simple as that. So any new member that bought their membership of one of these webinars and bought into these hidden gems have not only covered the cost of their membership, they're well and truly on the way to making some serious money in the market. So there's a reason why we put these hidden gems in, because one, we want you to join and buy them read the research first and then buy them. Make some money initially to cover your entry costs, but it's a no-brainer. The more money you've got in the market, the more money you'll make out of these stocks. You'll make some serious return.
Absolutely. Well said, Ed. So look, that brings us to the end of today's webinar. And again, we thank you everyone for your company today. We hope you got something out of it. And for those of you willing and open-minded to join us today, look, we congratulate you for taking the first step, because look, the comfort zone is where you're at, where everyone's at. If you don't step outside of the comfort zone, you will never find out. So for those of you, which we've got a few to contact today, we'll be in touch. For the others, look, we wish you all the best in your research. Clearly, it's not an easy job to do your research on your own. There's 2,500 stocks in the ASX, so it takes a lot of work, and we wish you all the best. And I'll pass it on to Ed for your final words.
Yeah, absolutely, Roger. So thank you everyone for joining. There's about over 400 today, which is great. That's a very high number. Everyone that I'm speaking to is a bit nervous about the market. They feel like we're going into a bearish period. Yes, we may go into a bearish period, but based on our track record, if you've got the right stocks in a bearish market, you can still make money. Your dividends will keep coming in. You've bought well if you're buying well, especially if you're putting new money in the market now, you're buying well. You speak to anyone that bought in March 2020 and April and May, they've made some serious returns in the market. And most of those investors, if they're still holding those stocks, they're still well and truly ahead, collecting income and dividends on that initial purchase price. So we can show you the stocks, we can show you the strategy. You've got to make your own decisions. You do your own buying, your own selling. We don't manage your money for you, but we'll give you all our professionalism, our guidance, our research to help you, get on the right foot if you're a new investor, or add value to your existing portfolio if you're a long-term investor. Thank you.
All right. Thank you. All the best.